Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And today we have our full cast of hosts and co-hosts. Ramsey, welcome.
Thank you. Great to be here.
Will, good to see you.
Yeah, always good to be here. Happy to welcome Dave.
Yeah, and Mark Fitzgerald, welcome.
Thank you, Paul. Great to be here.
Yeah, and welcome. We've got a great guest. This time we have a guest from another insurance carrier, and looking forward to insights and perspectives. Mr. Dave Hanzlik. Dave, will you mind just giving us your quick introduction to what you do, and maybe tell us a little bit about CUNA Mutual?
Yeah, sure. Thanks for having me, guys. I really appreciate it. And I think this is just a testament, Paul, that even though I work at another insurance company and we are competitors, we also are really interested in this space and helping people because it's really important. So Dave Hanzlik, I work at CUNA Mutual Group. CUNA Mutual Group is a insurance company that's been in business over 85 years and was started by credit unions. And for much of its history, it's been focused on credit unions and helping their customers with all sorts of different financial service needs. And I came there about 10 years ago to help them really build out their annuity space. So I lead both the annuity and retirement product areas for that company. In my background, I'm an actuary. So right now I'm actually looking at your feet. I'm an outgoing actuary. So that's, I'm not looking at my own feet right now. I'm looking at your feet, guys. But actuary and focus on product annuities, retirement. And, we're really excited at our company because we think this is a really great area to focus on to help people with retirement. There's a huge need in the country. I also wanted to point out that I told my 9-year-old that I'd be on That Annuity Show, and he is pumped. I mean, he was showing me all sorts of different episodes. I'm like, I've watched this before. You've never been interested, and he's very excited. So,
well,
you gained a 9-year-old as one of your listeners and watch.
Wait a minute. Can you tell him to boost it on TikTok for us?
Right.
We'll get way more attention than we'll ever get on LinkedIn.
Dave, we start our listening population young, so that we can pique their interest at the age of 9.
You guys should be.
Exactly. We're happy to send him stickers. We actually do have That Annuity Show stickers.
It's a true story.
Okay. Yeah.
I've given some to my kids too. So
well,
they'll end up on your fridge, maybe your car. So good things happen.
Yeah.
Yeah. Well, let's start out by just talking about the customer, your end customer. So are all the customers you're serving at the moment, is the connection between you and the company directly related to having being a member of a credit union someplace in the country?
Yeah. So the majority of our customers in our annuity business or other businesses we're in, insurance and other financial, are in credit unions. And the way we connect with them is through relationships at the credit union level. And that's, those are the strong relationships we've built over the last 85 years. And so we have on the annuity side, we actually have a broker dealer that creates the financial services programs for these credit unions. We work with a lot of large credit unions, but really there aren't any credit unions that have their own dealer that they sponsor. So that's how we get access to those the credit union customers, which they call members. We also actually are in the bank and independent broker dealer space as well. We've been building that out. So, take us 20 years ago, the company, all of its business would be in credit unions. Today, we're doing 30-40% of our annuity business outside of credit unions. So we've got an interesting, unique perspective on some of the differences between banks, credit unions, independent broker dealers, and credit unions. And there's a lot of similarities as well.
Hey, Dave, just a quick follow-up on that. Are you geographically dispersed throughout the country? Do you have a certain target, geographic area? And are credit unions using you among other broker dealers and distribution other companies, or are you guys kind of the at the forefront for the
right? Yeah. So we're across the entire country. There are some geographic concentrations of credit unions, but we do business in every single state in the union. There tends to be a bit of a concentration of credit unions out east, but there's plenty of them in California. And when it comes to a credit union that has a financial services program, they'll contract with one broker dealer, and so there's a handful of broker dealers like our own that focus on credit unions. They also tend to be, we're focused on credit unions. Some of these other companies will focus on credit unions and banks, because a lot of the financial service needs and what those advisors are encountering are very similar between credit unions and banks.
Are most of your credit unions open now, or are they, lobbies open? Are they fully operational, or are they working kind of remote?
Well, it's a mixed bag depending upon where you are. So, for example, where I'm at, it's by appointment only primarily. I found that out actually a couple of weekends ago when I went to my safe deposit box and realized I can't get in. I got to make an appointment at that time. But yeah, I've heard a lot of, the advisors have been, pretty creative about dealing with the environment. A lot of things I think you guys have heard across all the different, spaces, meeting at Starbucks, meeting at parks, people coming by and, ringing the doorbell, leaving paperwork on the front stoop. What we find in credit unions as well as in banks, that these institutions had made a lot of advancements in terms of order entry systems. And so not everyone had embraced being paperless, but a lot of these groups were positioned to be paperless. And so they've been really trying to engage in that. So that just helps with some of the, nuance, even areas that are a little more opened up. They might have customers that don't want to meet in person because they might be in a higher risk group. So there's been a lot of creativity. And, what we found was, like, everyone, the second quarter last year, there was definitely disruption in all the channels we were in, but we certainly saw a strong rebound in the third quarter. I think it's because of some of the infrastructure that these institutions had in place to support their advisors.
So interesting. So if I pull a thread a little more. So if I'm a typical advisor in your core business, was my office inside the branch, or was I really had my own office but was affiliated with the credit union?
For the most part, you had your office in a credit union, or you might have your office in several credit unions. Because a lot of these credit unions have a wide geographic spread. So you might have, 2 or 3 offices over, 1 or 2 counties, depending upon how, urban the areas you're at. But, for pretty much all these advisors are going to have an office in the credit union. That's where they would meet their customers. Sometimes they go out to meet their customers, but primarily they meet them at the local branches.
So I find the comment a little ironic. I think it's true, but let's explore it, which is, wait a minute. The advisors who were used to working in an office that people could walk into actually recovered faster than agents who were independent, had offices outside facilities and were used to potentially meeting people in other places. Just, can you make some sense out of that for us?
Yeah, and so there's a little bit of that technology. A couple of the things I think were in play, Paul. One was there was a lot of money that flowed into banks and credit unions this year. So a lot of people were, they were putting money in cash, right? And so there was, and I think a lot of these institutions, they had more cash than they needed. And I think they also realized that some of this needed to be put to work. It wasn't, there was people were over liquid, if that's even a phrase. And so what we found quickly with, the advisors in credit unions and banks was, hey, we're also not getting the referrals we normally would. So being in the branches is important because you get referrals from the tellers, from the loan officers. And even though, you're still part of that institution, if you're not there physically, it's harder to get those referrals. So there was a lot of shift to, okay, how do we start working our book of business as well as working back with the banks and credit unions, and the online presence and was huge. As you know, a lot of banking has started. A lot of banking was being done virtually, but has even shifted more virtually in the last 10 months. And so the advisors were doing a nice job of trying to link into now the virtual, the lobby, right? And so they really worked back into, a lot of online seminars, and then how do they reach out to the customer bases in line with the kind of marketing that the credit unions banks were doing via their websites. And so that's, it was funny, like, I think a lot of people think of, banks and credit unions advisors being transactional. This year they really dug in and really started to work on, hey, we've got these relationships. How do we, take advantage of this institutional backdrop? And I think they rallied really well in the environment they were in.
So can you talk a little bit about, sorry.
Can
you talk a little bit about what the typical credit union customer looks like? Is it a mass affluent? Is there some high net worth? What is the typical profile? What are the marketing personas, if you will, in this space?
Yeah, Ramsey. So I think you'd find, you hit the whole, credit unions represent all of America. There's over 100 million credit union members. So like a bank, like a credit union, they have working, mid-market, mass affluent. And so we have customers across that. I mean, I have to sign off on $1 million tickets all the time. And then, we'll have, in our fixed annuity, our MIGAs, we'll have average $50,000, $60,000 tickets, right? So on average, so we get a whole range. But I'd say the personas that are focused on are primarily mid-market, but then also having flexibility around accommodating that. You've got mass affluent, you've got affluent members, as well as you've got members that are in the working market, or are early in their journey of adulthood, and may not have a lot of savings, might still be really focused on student loans. So, but I think when we're working with credit unions, it usually starts around mid-market. Then the other thing you see with credit unions is they have a segmentation background. Most are community charters now, where they can work with anybody. But the history of credit unions was, hey, they were started around, hey, they served the local factory, and they were so you had to be someone that worked at that factory to be a member of that credit union, or you were a member of the military. A credit union that was built around the military base. Most credit unions at this point, community charters, where they can take all of us, even if they start out as an airline-based credit union, or that sort of thing. I just bring that up as some of these credit unions, even though they're community-based, they will have potentially a strong military presence, a strong presence with whatever the major employer was, postal service, whatever that is. And so that can sometimes be something that there's a little nuance to that local marketing. When it comes to providing annuities, financial services, we're going to focus more on the broad mid-market, mass affluent sort of personas.
Sure. I just want to let you know that you also gave us the snippet for the for the post. I sign $1 million tickets all the time.
Got it. Well, it happens.
Hey, Dave, you mentioned that annuities were, we're on that annuity show, and you have a background in annuity. So I want to go back to this. So you said that you were excited about, or you were, excited about the future and what annuities bring to bear for retirement and whatnot. Can you talk a little bit about the annuity marketplace in your credit unions, and what you're seeing and where you're seeing growth, and why you're excited about it, why you're excited about annuities for your clients?
Yeah, absolutely, Will. So, what I'm excited about is, there's like a huge need out there. I think, I think many of us saw there was, I think this was, I think I wrote this down somewhere where it came from, but it was, the Institute of, oh gosh, some firm in the last couple of weeks published, it was a number that 7% of retirement assets are in annuities, and that's the lowest level it's been since 1974, whenever this group started measuring it. And so, and as you guys know, like, there aren't a lot of defined benefit plans being offered in the private sector, today, and they certainly aren't like the defined benefit plan that my dad enjoyed, which is he can live basically off of that alone. So, huge need out there and a lot of creativity. Combine that with the lowest interest rate environment, we've seen in our history. Today I was in a pricing meeting, and what we do is we in our pricing meeting, we'll look at historical interest rates, and we'll have like yield curves. And I took a double take because I looked at it had a snapshot of today. In today, in the chart, it was the highest level of rates was in that chart. And I was like, how can that be? And it was because it was over the last, it was a snapshot of the last 9 months. We're the highest level of rates. So we were still below 2% at the long end of the curve. So I bring all that up as there's a lot of challenges out there. And I think annuities are in such a great spot to help people from a number of different angles. So one example would be fixed annuities. Interest rates are super low, but you can find great value in the MIGA space today. Whether you go to a bank or credit union, CD rates are so low. You can find, great rates in the fixed annuity MIGA space. These are guaranteed products backed by insurance companies. Those are wonderful solutions for helping people that need this absolute guarantee. Tons of creativity in the RILA, registered index linked annuity space. That happens to be a space that my company focuses on, specializes in. Great things happening there. Primarily been focused on the accumulation side, but there's a lot of there's starting to be some more creativity on the income side, and I think that's another bright spot, and that's resonated in these financial institutions. I was looking at a stat that around 50% of the deposits in variable products in banks and credit unions through the third quarter last year were in the registered index-linked annuities. 50% of variable annuity sales were in registered index-linked annuities. And I think that's just a trend that's just going to continue, where these are solutions that they provide real guarantees, and they give people upside potential. So you've got both those elements going on, and I think this is a great time for annuities and annuity companies to step up, and annuity producers and those that understand their value to really look at them. And if they haven't, you haven't been using annuities, you really shouldn't look at them right now, because there's a lot of things to try to navigate out there, and they provide a tremendous amount of value.
Dave, I know historically rider utilization on index annuities in the bank and broker dealer space has been slightly less than that of the independent agent side. Have you seen much shift in the last 12 months, migrating more towards utilization of riders?
Yeah, Mark, and have not. You're spot on. We have not seen that, and it hasn't been shifting a big way yet. But I do feel like this is a place that's a place that I feel really bullish in terms of the space. That I think, post the financial crisis, there's a lot of pushback on the more rational pricing of variable annuities and their riders. And, I think that the creativity that we've seen in the fixed index annuity space, and I think we're going to continue to see in the RILA space, I think potentially we'll see some creativity over time back in the VA space as companies start to, companies maybe that weren't traditionally in the VA space start to look at it and say, hey, this could be a place that we could help out. I think you're going to see more attention brought there. And I think with, banks and credit unions, I think their customer bases are continuing to get older. And there's groups that are coming through now that don't enjoy defined benefit foundations for their retirement plans. I think that's going to change. But, Mark, we haven't seen a big change in that in the last 12 months, outside of some of the success we've had in our own income solutions.
And how about in terms of product mix as a whole? Like you mentioned, 50% of the variable product sales are RILA. Is that because the overall variable pie is reduced a bit, or is that just a major uptick in the RILA market?
I think it's both, Mark. I mean, I think it's the variable space has still been, the variable annuity space has been suffering, but I think, the creativity in the RILA space and just the relevance of those solutions, I think that's really driving a lot more of that growth. And, I think, you've seen it in all the channels, you're starting to see an uptick in the usage. I just think in banks and credit unions, they've been faster to it because of, an appreciation of those, accumulation guarantees and, the safety that the RILAs are representing.
Yeah, certainly a lot more coming to market for sure.
Yeah, I noticed the same, Mark and Dave. I mean, the RILA there seems to be a proliferation in the industry. I think we're noticing that.
I agree, Will, and I think early on there was really a focus on basically buffers and floors, and I think still that's a starting point, but I think people have been looking at custom indices. They've been looking at different ways of structuring the payoffs, and I just think advisors too have gotten used to. There's always been a lot of advisors that use structured notes, but I think what we found with it's been 7-8 years now since we've seen. It's more like 10 years now since the RILA space has really started to be start on the annuity side. And I think advisors are starting to really get used to the concept that within an annuity, and this stuff kind of builds on itself, where people start to figure out how this fits with the client's portfolios, and now you're starting to see different sorts of payoff structures that continue to be they generally are pretty straightforward. Some are a little more complex, and that's for some people need a more complex solution for their need, what they're looking for, upside potential. But I think they're very, very on point to helping people, because generally what you see a lot of you need that downside protection. You want that downside protection, but you need that upside potential, and that's what a RILA can really get after for people.
Yeah, well, you certainly get much higher upside potential than you would with a typical FIA. Of course, with that comes the risk. Hindsight's 2020. In how many years of a bull market have we been in? Even when you think there shouldn't have been, it's been a pretty safe bet if you've made it with your retirement money. I guess just going forward though, if I'm an advisor now, the advisors in the independent space, them in your traditional sector. If I'm a typical advisor, I've been selling FIAs. I've sold a few MYGAs. Every once in a while, I'll do one of those. I did sell VAs. I gave up my license. What should I be focused on? Should I be chasing RILAs at this point? Should I be headed more towards the fee-based business and building up an RA? And maybe I should be looking at fee-based annuities. Where should I take my practice?
Yeah, I think first off, for sure, it's always important for advisors to be keeping abreast of what's new and challenging, their practices, right? I mean, I think that's what, for the most part, advisors are always doing. That's, they have to. And so I think RILAs are an important thing to be investigating right now. They're gaining momentum for a good reason, right? And like you said, Paul, there is risk with them. They're registered products. But, there's very few clients that don't need to have some exposure to registered solutions, right? Whether it be mutual funds or stocks or, managed accounts, those sorts of things. And these are great solutions for those that need more protection than in a fully pass-through sort of solution. So that's certainly one of the first places I start. I go back to I highlight MYGAs again. MYGAs are a great solution. And I think a lot of people are worried about the uncertainty out there, or they still need to have exposure to a conservative fixed side of their portfolio. And I think MIGAs can offer something that's not necessarily there in cash alternatives bonds right now. The fee-based business is a really interesting one. I think generally that comes to a bit more of a question about your strategy as an advisor. I've seen pronouncements of people, I think you guys have seen it, that some people are like, hey, in 3 years, there's going to be no commission business. It's all going to be fee-based. I don't really believe that's going to happen. I think that's a bit of a result of a bull market, like you were talking about, Paul. I mean, a bull market, bull market, fee-based business is great because, hey, every year everyone's balances are going up. So I think that's a bit of an overreaction. But I do think there is some value. I think there's a lot of value to it. And I think people should, explore how does that fit in with how they're working with clients. Certainly there's been work in the fee-based annuity space. So if you are interested in and you're worried about, hey, can I still use annuities? You can. There isn't as much availability, and we're still trying to figure out as an industry how to appropriately work with the processes, that the technology that you need to work with on the fee-based side. But I can tell you, every one of my counterparts at insurance companies are either they built it and are trying to improve it, they're looking at it, and that's it. No one's not looking at it, right? Everyone's either doing it or looking at it because we think that it's something that it has real potential. But the jury's still out how big it is. But I would say, if you're an advisor, RILAs, MIGAs, and you got it right there, Paul, I think you should look at how the fee-based business might fit with what you're doing and how you're trying to serve your clients. And is it a potential place for growth for you? Because it is getting a lot of attention right now. And even though it seems like there should be a bear market that follows every bull market, I think it's like 5 years ago I was saying, hey, this could end at any time. It's when is it going to ever end, right? I don't know. And so the past does not have to repeat, right?
Hey, Dave, just to switch gears up quickly because I'm interested in it, more so as kind of the development of the banking industry and the credit union industry. So how are you stacking up and confronting the challenges of these smaller technology neobanks that seem to be the fastest growing banks in the country that don't have brick and mortar locations and don't have they're all on apps and whatnot, and they seem to have some very competitive rates. So are you guys feeling the impacts of those disruptors, or what's your strategy?
Yeah, so it's not my strategy, it's our client strategy. So just to be clear, we're just an insurance company, but what we have seen is and what we've tried to do, we've tried to help our clients with, has been trying to improve the technology and the accessibility of the services of the credit unions, as well as the banks as well. And some of these banks are have shifted really close to some of these new virtual only strategies, right? Well, I mean, and some of these banks have been able to do it faster because they've got a lot of resources to go there. But so I think there's been a big investment to be more relevant and serve customers where they want to be served. I think the other thing that's been focused on is how do you capitalize on the different offerings that you already have, and make that something that continues to retain or attract new customers. And so there's a lot of exploration into what other things that we can do as a bank or a credit union that makes us more relevant, versus just being a rate that you can find on an app, or hey, this is just I can scan a check and I'm done. So certainly it's not being ignored at all. There's a lot of focus on it, and especially with the credit unions who are very focused on they call their customers members. they're very focused on, service and, trying to be as, they're really trying to put their customers first. And so they also see this as, hey, this is, evolving need to make this more accessible and make this easier to work with us. And so it's not just about relevancy, it's also about, hey, this is what, because we are focused and built around serving our members, we need to improve in this space because that's just the way the world has evolved to.
I guess going back to the study that you cited earlier about the 7% retirement assets and annuities being at the lowest levels, and obviously that's pretty counterintuitive to your prior comment about defined benefit plans being less and less currently. What do you think is behind that number, and how do you think the best way to shift that number to a greater percentage going forward is?
Yeah, so I think one thing, Mark, is it's this bull market. I think that people are not valuing guarantees as much as they have been. I think the second has been, I think the advisors have looked at the cost of guarantees, and they said, wait a second, 15 years ago I could have gotten a withdrawal benefit that guarantees 6%. Today, to do that, instead of only paying 35 basis points, I have to pay 150 basis points. That doesn't make sense. That's not valuable. On top of that, I used to be able to, I could invest however I wanted, a 75 fund investment menu. Now I've got 13 vol controlled funds that I can choose from, so there's these things that I think that, advisors just, are saying, hey, is this really as valuable as they used to? I think those are two big issues. And then the third is just, and that it's just hard for people to wrap their heads around. This is a core challenge. And I know you guys have talked about this with some of the guests in the past, like people just don't know how to look at long-term risk and guarantees. And we still, this is beyond an advisor and customer. And this is like an industry challenge of continuing to get the word out. So, I mean, Paul, some of the things you guys are doing with the Innovation Lab, and, these are things that we got it. And I think the show is like, we're trying to get that word out, like, hey, these are things that are really hard to wrap your heads around, but that's what, our customers are relying upon us as an industry to say, hey, look, like you could live to 98 and the market may not return 8% on average over the next 40 years, right? I mean, these are things that could really happen. And guess what? Your only guarantee is $30,000 of Social Security. It starts at 65 because you don't have a defined benefit plan. So how so I think that's maybe been always an issue of just trying to help people kind of figure out how to think beyond the next 12 months or 24 months and to really understand longevity and financial risk and provide some context and help them see like annuities are a fantastic tool for dealing with long-term risk. They've gotten really good at dealing with shorter term accumulation risk, but they also, like, their bread and butter obviously is long-term income guarantees, longevity risk, long-term income risk.
Yeah, it seems so obvious to all of us on this show that there's a complete lack of defined benefit plans or defined pension plans right now. And, our parents had them and everyone had them. And you'd think there would be this tremendous pent up demand to really, really focus and look at annuities as a alternative to that, or as a tool to provide you that income. I still think that there's not enough people looking at it or considering it as a kind of a replacement for those pensions that they don't have. I don't know how you change that paradigm, but it's one I think we've talked about many, many times, and I think it needs to happen.
Yeah, I mean, I know I'm buttering up to the host here, but I think that annuity show is a great thing to have out there. Like, really continue to push out there. Hey, look, annuities have a lot of value, and we need to keep preaching that to advisors and try to get out to the general public. Like, you should consider these things. there's somewhat of a checkered sort of feeling when you talk to someone. All these surveys about some people are like, well, what about fees? What about this? What about that? And at their core, they're a defined benefit alternative, or they're a CD alternative, and there's all sorts of variations in between that can really get after a lot of different needs. Your need for upside potential and liquidity and guarantees, your need for just a lifetime income guarantee. Where else are you going to get that? There are no other financial instruments that can do that. And there's been a lot of, and I really appreciate there's a lot of creativity in the financial services space, payout fund, a payout mutual fund and things like that, where people are really trying to get after it. But, in the end, we know that this can be a powerful part of any, a powerful foundational block for anyone's portfolio. Whether you go back to, you were talking about our customer bases and credit unions and banks, like $1 million tickets, like, hey, there's a lot of affluent people that can really use these and really see the value of them, as well as going down to someone that has $30,000 and they can be really important too. And so I think we just got to keep pounding the news outlets, keep talking about it, even bringing it up over well, I guess now it's a virtual beer, because I guess we can't have cocktail parties like we used to, like, not being afraid of kind of talking about what we do with our friends and family, because I think everyone should hear about what a great part of the industry these solutions can be.
Well, it's always a bit surprising to me, the disconnect. I mean, if you think about the majority of Americans spend their working career for a salary, for a guaranteed paycheck, versus those that work for 100% commission. And you'd think that mindset would tie in very well to the need for a guaranteed solution in retirement. Why not continue that guaranteed income stream? And I'm really surprised that we've not seen more of a migration towards that than we sit currently.
Yeah, it's a head scratcher. I don't want us to have a bear market. That is one of those things that I think could be really interesting if we have a bear market, a real market drop. How does that kind of shock the system? But you also know that, as we've seen, there's been more regulatory activity that's focused on income. I think like the Secure Act, try to provide a little bit more focused on income through 401ks, and I think those making it easier to have income guarantees be made part of 401ks. So I think those are positive developments. But yeah, I know, Mark, it's a head scratcher. But I think we just got to keep pushing, and I think the innovation that we're seeing in terms of how types of products that are being delivered, continuing to see changes in our space where the fee-based movement for a lot of advisors, and making sure that annuities can be part of that. Those are all things that can allow us to meet this really important and growing need for Americans.
Without a doubt.
Yeah. Hey, well, listen, it's music to our ears. Okay, we can't get enough of reasons why people should look at annuities. But hey, Dave, I want to thank you for your time. I guess any last thoughts or questions?
Yeah, I just want to say thank you for having me on. Really appreciate it. Fan of the show. Of course, I expect to see some stickers for the 9-year-old who's going to be your latest. I know you're looking to penetrate that under 10 demographic, so
exactly.
I'll try to help out as best I can here. But yeah, no, it's a real pleasure to be on, and really appreciate what you guys are doing with this show. It's very interesting. It's an easy listen, on the bike in the morning, or on the treadmill. And
I'm glad you said not when you're going to sleep.
No, definitely not.
Bike in the morning is better than trying to find some Z's at the end of the day.
No, this is good. This helps me get going, and it's a real pleasure to be on and spend time with you guys.
Hey, great, Dave, a pleasure, and thank you for your insights. If people want to reach out to you, have more questions about what you've talked about or some of your ideas, LinkedIn the best way to connect with you, or
Yeah, LinkedIn is great. Reach out to me that way, and you can also go to the CUNA Mutual Group website to learn more about us and reach out to us in that fashion. LinkedIn is best for me.
Excellent. All right. Listen, hey, thanks so much. And thanks for listening. And join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.